Chapter 3. Federal and State Income Tax Withholding. The second way to calculate the income tax withholding is to use the percentage method, which is a three-step process. The first step is to multiply the allowances by the figure in the allowance table. So what is the figure in the allowance table? Well, first, the allowance table is in the back of your book. So locate that, and then in this table, see the column payroll period. Find what is the payroll period. For example, let's say it's semi-monthly and the corresponding allowance for 1 is 175. But if it's 3 withholding allowance, then use the number 3 times 175. Then you get the allowance amount. Use that allowance amount and go to step 2, which says subtract the step 1 allowance amount from taxable pay. In other words, take taxable pay and subtract calculated allowance amount. Then you get the taxable pay to look up in the percentage method table, and that's in step 3. Locate the percentage method table in the back of your book. In this table, on the left-hand side is the status for single. In the right-hand side is the status for married person. Then find the appropriate payroll period, whether it's weekly, bi-weekly, semi-monthly, monthly, and so forth. Look where the range is and find the taxable pay that falls in that range, and then do the calculation as per the table. For example, we see that the range $260 to $832. And it says $18.70 plus 12% of excess over $260. In other words, the calculation is to first take the wage or the taxable pay that's calculated minus $260 times 12% and then add $18.70 and you arrive at the amount of income tax withholding. Employees update the W-4 form when there's a life-changing event, for example, marriage, divorce, birth of a child, or a job change status. Changes result in an adjustment to the federal income tax withholding. The W-4 form must be submitted within 10 days if the change is to reduce the number of withholding allowances or a change of status from married to single, such as when there's a divorce. So what do these two items implicate? It implicates that there is an increase in the amount of income tax withholding, and therefore the government wants more money right away. And so they require that the W-4 must be submitted within 10 days of the change. Now, if the update to the W-4 form is to increase allowance, then there's no time limit. When an employee that's working passes away, a portion of the employee's earnings may be paid. However, these payments are not subject to federal income tax withholding, so the federal government does have some empathy after all. Employer must process the updated W-4 form no later than the start of the first payroll period that ends at least 30 days after submission of the new form. For example, Mike submits a new form on October 19th. His pay period is semi-monthly and he is paid 7 days after the pay period. When must the employer make the update of his W-4 form? Let's think about this. It must be 30 days after submission of the new form. So Mike submitted the new form on October 19th. Then approximately 30 days from October 19th is November 19th. And November 19th is 30 days approximately after submission of the new form. Then November 19th falls in what pay period? It falls in the November pay period from November 15th to November 30th. So the update then will be in December, the first pay period that ends at least 30 days after submission of the new form. And Mike is paid 7 days after the pay period, which means 7 days or a week after November 30th. And then he would see his paycheck updated with the W-4 form, the new information that he provided. State income tax withholding. This is calculated based on state taxable income, and it may be the same as federal. However, calculations differ from one state to another. 9 states do not collect state income tax. Some states levy a flat tax. Some states levy a graduated tax. And due to the variability in state income tax withholding rates and methods, we will use 5% rate for simplicity in this class. Local income tax withholding. The tax rates and how they are levied varied widely. Some has a flat amount, others percentage of gross pay, or percentage of federal or state income tax withholding, and so forth. They may differ for residents as well as for non-residents.